Howdy, Jacob here. Today we're looking at ticker symbol AGYS. It is in the software industry, 2.2 billion market cap on 2.1 billion enterprise value, founded in 1932, so it's been around for quite a bit. They operate as a developer and marketeer of hardware and software products. Okay, so Pioneer Standard Electronics was what it was formerly known as. That's probably why it was 1932. I was like, software didn't even exist back in 1932, but anyways, pretty small company, 2.2 billion. The growth has been a little not crazy, less than double over the last 10 years, with gross margins down a little bit and operating margins still single digits. So it sounds like they still, or it looks like they still have quite a bit of room to improve on their margins, especially 60% gross to single digit operating is pretty big differences. It looks like that is due though to R&D being fairly high, 56 million of their 138 million gross profit. So they are spending quite a bit on R&D, which can be positive. It just depends on if they're able to convert that R&D into actual profit and revenue and cash flow. If they're not able to, then it's really just a throwaway money. But in most cases, I think that if a company has been doing a good job at reinvesting through R&D, then it has been able to show out. So I guess we'll see whether they're able to throw that into actual profit and cash flow. It looks like they have produced quite a bit more cash from operations and actually have less capital expenditures than 10 years ago. So that's pretty impressive. Starting to um, they're starting to produce quite a bit of cash flow, which is good. And their use of cash flow is they're paying a dividend right now, or at least they did pay a dividend for a little bit. It doesn't look like they're paying one now. Maybe it's just at the end of the year, if they do pretty well, they throw out a dividend. But it doesn't look like they have any quarterly dividends or anything that pays out 2 million. So that's nothing in comparison to their cash flow. And then really just buying back shares and increasing that cash position on their balance sheet. So the balance sheet looks very safe, 98 in all of their liabilities, no short term, no long term, and 113 million in cash. So no concern on the balance sheet. But they do buy back shares, but it doesn't quite offset their stock based compensation. So we will see a slight increase in shares outstanding a bit. So let's start making some assumptions here. I think that this would definitely be something a company I'd want to look into. So to be a software industry founded in 1932, you know that this company has gone through some changes, and I'd be very interested to see how those changes are going into effect. And I mean, it looks like they're going into support maintenance and subscription services. I think that's fantastic. Subscriptions are recurring revenue, which is always great. You just need to have a great enough platform so that it is truly recurring. But I think that to me, 5% seems pretty reasonable, and then 15 PE price to free cash flow. I don't think it deserves any PE beyond what the market historical average has been, and so I'm pretty comfortable with that. I think their growth rate will probably be higher just because the fact that they're a smaller company, but I think that we haven't seen any moats anywhere. And I mean, again, if the company's spending a lot on R&D, that can be very positive for the future, but I won't be banking on that with my conservative assumptions here. And then maybe let's do 8 and 12% with increase of shares of 1% would be about 20 million. And they are buying back shares. So let's just do 1%. And it looks heavily expensive right now, which I guess doesn't surprise me at all. It says their earnings per share of last year was 50 cents and they're selling for $82 a share. So it does seem a bit expensive to me at these prices, and I'll just be waiting until it comes down quite a bit. Hopefully you enjoy the video and have a great rest of your day. Thank you.